Okay, now we're actually live. So thanks guys for being patient with us. I hit the wrong button, so you guys have been sitting there. I appreciate you guys being here. We are excited to have Scott Estill on tonight. You see George right there live. It looks like we lost Scott for a minute, but
probably when we went live, you may have had to reshare your screen there, Scott. But yeah, Kendall, let us know when you're ready to get going, and we'll get rocking.
okay, yeah, just good to see some old friends there. All right, it's nice to see Karen and Sherry on. Thanks guys for being here. Karen, I hope Rick's doing well and you guys are doing all right. It's good to see you on here.
Wow, yeah, a lot of familiar names and not faces, but a lot of familiar names and some not so familiar ones. So this will be great for a lot of newbies as well. So.
Well, Scott, I just want to do a quick test before we actually get started. I want to make sure you can hear me okay. We can hear you all right. And then if your screen goes dark, that's okay. But if we can see you, it's always nice to see you. Ah, so we did lose them. It's the snow up at 9,000 feet in Dillon.
No, everything just went dark on me here, Kendall.
Ah, there you go. Well, you're not necessarily part of the dark side anymore, Scott, so I'm glad it's not too dark.
No, I hear you.
So yeah, it looks like you got back online again. So if you share your webcam and we can hear you loud and clear, that's awesome. That's great. We're just about ready to get started. So
yeah, thanks for being here online, everybody. We appreciate you being here early.
All right, we're ready.
Boom.
Great.
Boom, boom.
All right. Well, I'll give a shout out quick to Rick and Karen. Thanks guys for being on, Rick. I'm glad you're doing better, buddy. That's good to see you. Good to have you on, guys. All right, I'm gonna go ahead and hit record. We are set to go, guys. Thanks for being here.
Awesome. Thanks, Kendall. And keep us posted if you have anything in particular. So I'd like to welcome everybody to the Protect Wealth Academy call, this webinar for how to save thousands on your 2019 tax returns. This is going to be a hot topic, to say the least. But we are really excited that you're here, and we're gonna get into just a couple of housekeeping items, give you a little update. I'll have you'll notice you've got a couple of videos of myself. My name is George Wright III, joined here with Kendall, as well as our guest speaker Scott Estill, and he's on video. And we've got a PowerPoint. We're just going to go through a couple of initial items, and then we'll jump right into it. We've got some great questions and things that we want to gain some wisdom from Scott on. So Kendall, why don't you go ahead and push forward on our slides? So I want to just make sure everybody realizes we have a couple of private events coming up, these Protect Wealth Summits that are going to be in Phoenix as well as Anaheim, and you'll see the dates there, but we'll give you a link a little bit later. If you have been to the summit, we've got some great new content and information on asset protection, tax strategies, estate planning, and we're going to go through that. You'll see a sample agenda here as well. But for those of you that have been with us before, there's a lot of new content and stuff that we're going to be releasing. For those of you that have not been with us before, Protect Wealth is the longest running financial education company around. We've had just literally tens of thousands of people attend our events. We're super excited about the 2 summits we have coming up, and we will be dropping some amazing value in some webinars over the next couple of months as well. We also, you'll notice here, we have a cruise coming up at the end of the year. That's a high-end cruise where you'll be able to network and roundtable with some of the biggest and best minds, 7-figure mentors that we work with in stock, real estate, asset, tax, legal, estate planning. And so we'd like to encourage you and invite you to join us there as well. And of course, our partner and mentor, Don Pendleton, always likes us to have our official disclaimer, and I'm not going to read that. He might read it. I'm not going to read it. But bottom line is, not everything we talk about is going to apply to everyone. We always recommend that you seek out your professional, whether it's legal, tax, or whatever services you're looking for. However, we are going to cover some amazing value here tonight. So without any further ado, I'd like to just kind of introduce, but before I do, just tell Scott that we are very grateful and excited to have him on the call today. He's a tough man to get a hold of because he's traveling all over the world. But Scott, thank you so much for being on the call with us today.
Absolutely, George. My pleasure.
Well, listen, I know that there are many people that seek your time, and there's a lot of people that may know you, but there may be a few that don't. So I want to do you the honor of just giving a real more official introduction. And so for those of you that don't know Scott, he's an attorney that actually has been for quite some time working with us at Protect Wealth. He's a ongoing guest speaker and top tier expert at our Protect Wealth events. But he's a nationally recognized and sought after author and speaker. He's written multiple books and workshops that have helped people and businesses just save thousands on their taxes in tax deductions and tax strategies, and for immediate and future and long-term needs. But his most recognized book that I love, a couple of versions, is Tax This. And until 1995, Scott was a senior trial attorney for the IRS, but he left the IRS to give taxpayers the edge by showing them how to fight the IRS and win. Since leaving the IRS, he's sued the IRS over 2,500 times and never lost a case. That's amazing. I mean, if you want to have an advocate for you on taxes, it doesn't get any better than that. Scott, I know you have a law degree from John Marshall Law School in Chicago, and you're licensed before the U.S. Tax Court. But ultimately, your expertise and knowledge is amazing, but your insight on how to apply that with entrepreneurs, investors, and business owners is just unmatched. So once again, thank you so much for being here, and I hope everyone really takes good notes, because we won't be able to get to everything tonight, but we're certainly going to do our best to hit some of the top things on the list. So thanks again, Scott.
Thank you, George. And I think one of the things to keep in mind is, with the IRS background, and just correct you on that. I mean, we have certainly gone into tax court and not won every issue. So we have lost some cases, but I think the main thing to point out here is that there's not a lot of different tax professionals that have been on both sides of the coin. And I think that it's one thing that gives us an advantage, gives myself an advantage when we're trying to come up with some strategies that, will beat the IRS.
Well, yeah, and you make a really, really amazing point that I've learned through experience with my businesses, and that is that the bottom line is most people either lack the education or the information, or they have fear. It's a funny thing, but fearing, the IRS and audits and things like this. So to have someone like yourself with your background, it's not just informational, but it really can help to give a level of comfort to individuals. So what we wanted to do, rather than have Scott, like he does for a lot of our investor groups, give a bunch of information, we're going to kind of drive this call with questions. And Scott, with your brilliance and background, maybe I could ask you, we've pulled together some of the top questions from our past students and individuals, and I want to just kind of ask you and get your feedback and interact a little bit that way, if that's okay.
Yeah, that'd be great. Go ahead. Let's get to as many questions as we can tonight, and hopefully, again, I think what you mentioned, it's a mindset and it's an empowerment, and I think you get rid of the fear of the IRS, and hopefully everybody tonight on the call or who's watching this, after tonight, let's get rid of that fear, and let's just go ahead and do what the law permits us to do. So let's go for it, George. What do you have?
That's awesome. And one thing that we have learned over time, after many, 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 many years of working with individuals, businesses, and investors, is that the simplest, easiest, fastest way to increase your return and contribute to retirement is to not pay taxes. So that's really the fear. But everyone's got on their mind, and I'm going to just start right out with the most important question. People are asking us, is there anything I can do to reduce my 2019 taxes? Meaning the taxes I have to file, but the year is over. So maybe you could give us some insight as to what types of things they can do to still reduce their 2019 taxes when they file.
Well, I think the first thing would be to make sure you're totally organized and that you have all of your income, your expenses, your deductions, everything that relates to your taxes. Because I've seen quite a few different situations where people are just not organized, and inevitably they come in with pretty much all of their income, but are missing all kinds of expenses, and they overpay their taxes. So I think that would be the first place I would start. When you're looking at retroactive tax planning, though, it's really difficult, and actually about the only thing you can do right now that you haven't already done would be to contribute to a retirement plan. So if you contributed to an IRA and you could deduct that, or if you contribute to a SEP or a 401k plan, you could make the contribution today up to April 15th and make it for 2019 and have it reflect on the 2019 returns. And so one thing I used to do when I was preparing a lot of returns is I would tell my client, you're going to owe $5,000. And they would say, well, how much would it take for me to put into a 401k to reduce that to zero, knowing that every dollar they put into the 401k was reducing the tax liability. So, besides being able to contribute to a retirement plan, then we're really just going back to make sure we capture everything that we did last year. And I think the main thing then is let's look forward at that point and make sure that whatever we're doing in 2020, we have, perfect records or as close to perfect as possible so that we don't find ourselves in a situation where, we're coming up to tax day next year and we still don't have a tax plan in place.
Yeah, that's huge. I'll tell you, I've learned from being around you and being around a lot of investors and business owners that obviously, like you said, be prepared, be organized. But at the same token, if you don't know what to organize or what to prepare with, or you don't know what type of deductions you have, which we'll get into here in a little bit, I think that awareness, it is funny you mentioned everybody's accurate with their income. That's kind of the easy thing. But when it comes to the things that will benefit you, like deductions and things like that, they're just not. And it sounds like you've got to be ahead of that game, but also I think today we're going to cover some things that are going to allow them to maybe identify stuff that they don't normally identify. But on this topic of contributing to your IRA, is there any general thoughts or amounts or things that, I know it's going to depend on a lot of different individuals, but any things, are you recommending, if you have the ability, just maximize that, and that's kind of the main thing you can kind of do?
Well, yeah, I think, from a business standpoint, you can deduct the 401k and the SEP payments. And so that would be something that certainly would reduce your taxable income. If you get over to an IRA, then it would depend certainly on the type of IRA. And for most of the people probably listening into this presentation, I would think a Roth IRA would be the way to go. The downside, though, is that that's not going to help us with 2019 because there's no tax deduction for a Roth. So what are you looking for here? If you want to try to reduce 19 taxes, you could always put it into, I guess, not a deductible IRA, and then at some point convert it to a Roth. But you still have to play the tax game when you convert it at that point.
Yeah, well, I do love your point. I think sometimes people are thinking, well, shoot, it's too late, but it's never too late to start doing what you're supposed to do, which is why we're doing this call. But it kind of brings me to my second question is, what do you feel are the top frequently missed deductions or credits that individuals have? Are there some of those that come to mind that you feel like maybe people are forgetting, or top frequently missed deductions and credits?
Well, I think certainly for anybody with a business and anybody that is trading in the stock market actively, and also investors in real estate, I think if you have any one of those three, you're going to be in a situation where, again, you're going to almost certainly capture all of your income. But if you don't know what to deduct and you don't know what records you need to keep to support the deduction, you can find yourself in a bad place. Either you got audited and you can't support it, or you didn't even take the deduction to begin with because you don't have the records or you didn't know that you could do that. And, and I think that it kind of gets us into this sort of tax preparation versus tax planning idea. And that is that the tax planning is an ongoing thing. It's something that is very proactive, and it's something that you have to be doing as long as you're doing whatever the activity is. So as long as you're in business or as long as you have rental properties, you have to be doing some sort of tax planning and making sure that you're just not throwing all of your money to the government, right? I mean, that you're bringing your tax bill down as low as what the law permits.
Yeah, I really like how you draw that distinction, because I don't think a lot of people, and maybe they sort of get this, but they don't really get into depth, but there is a real difference between tax preparation once a year or twice a year with businesses, things like this, and tax planning. So maybe you could just kind of even drive a little bit deeper into what do you mean? I mean, obviously tax preparation is key, because you're saying be organized, get your deductions, make sure you have what you have. But tax planning, how do you recommend they literally separate those two types of things? And what recommendations do you have on both sides of the coin there?
Well, very good question. I think that's important to pretty much anyone on this call, just in the sense of what is the difference between the two? And when I was in practice, I did both of them. And I think I look at tax preparation as a reactive sort of an event. Everything has already happened, and I'm going to take whatever's happened and I'm going to put it onto a form or some sort of forms that work with the IRS, and they work with whatever state we have to deal with. So that's tax preparation. Tax planning is looking at something and then looking into the future and figuring out what should we be doing today, categorization, plan-wise, structuring of business entities, all these different things that can come into play. But what should I be doing today so that when I get to the preparation point, I've got things really locked in, and that once I get to the prep point, like today, there's nothing I can do for somebody on a planning perspective other than that retirement plan, the issues and contributing for last year. But right now we're in 2020, and we can't go backwards on any planning. So we're only looking at this year right now. And again, it's a very proactive way of looking at taxes as opposed to reacting to whatever happened last year or maybe last quarter for some business.
Yeah. I'll tell you, it's also a mindset, like you said right in the beginning, right? So it's not just understanding the difference between tax preparation and tax planning, but it's having a different mindset around taxes, right? I notice whenever I'm around you and we're in some of these private inner circle roundtable type things, people, I don't know if you've noticed it, but they seem to they normally don't ask as many questions. And when they're around you, they're asking all kinds of scenarios and questions, but I feel like it's because their mindset shifts towards opportunities to be able to save taxes. And so is this a mindset that you feel like is developed with, confidence and belief, or having the right professionals? Or do you feel like having a mindset for drastically reducing your taxes is just something people just need to start having?
No, I think it's something you need to acquire. And I also think that when you look at, everybody wants to hit the grand slam with reducing their tax bill. And so I want to take my tax bill from $100,000 down to $1,000 or something magical. And that's not typically the way the game is played, and it's not typically the way the game is won. And so I think it's sort of an incremental change that you get into a mindset, you get into habits of being able to do certain things. And then when you have a plan, or at least from my perspective, whenever I have a plan in place to do something, it's typically much easier for me to follow up on it, rather than if I'm just taking guesses every time I go to do something. And so to me, the structure of the plan is going to get me from point A to point B. And then once I'm there and I realize, all right, I just saved myself $10 in tax today, or I just saved myself $5,000 in tax by taking this expense that I didn't know I could take. Whatever the number happens to be, that's money that you can then use, to invest or to put towards your kids' education, or to upgrade your home, or basically to do whatever it is that you want to do with the money.
Yeah, that really goes straight to mindset, because if you have a limited mindset of how many deductions can I get, or how can I shave my taxes back as much as I can, you're really not seeing the long-term benefits of how it's going to compound and affect you. So the mindset should be in this planning not just preparation area. So I wanted to back up, and then we'll go back into planning and preparation. Is there some major changes that have happened or anything that individuals need to be aware of for 2019? Any specifics that come to mind for you in the tax law changes and things like that, that maybe some new people that haven't been with us before are not aware of? Or is there anything that kind of comes to the top of the page for you for changes in tax law?
Well, the big changes, the real big benefits from any of the tax laws in 19, and that's also going to be true for 2020 as well, are going to apply to business owners. And so individual taxpayers, us as people, we end up losing on the tax law. So again, I think the mindset has to be, how can I maximize my personal tax savings, knowing that the tax law really doesn't favor the personal tax savings. And so we need to be looking at, how do we have our business set up? How do we have it structured? How are we recording our income and expenses for our rental properties or properties that we're flipping or stocks that we're buying and selling? And we really need to be able to sort of hone in on whatever it is that we're doing and make sure that our strategies from a tax perspective match what we're trying to do from an income perspective.
Yeah, I really like, and I think that's been a common theme, that the single best thing I could do for my savings and taxes or tax reduction is to own a business. So I know we're going to cover some of that, but I want to back up for just 1 second and hit one more topic, and that is, what would you recommend to individuals for them to look for in order to find a good accountant and or a good tax planner? What are the key benefits? Because people are looking online, they're trying to do it themselves, they maybe have a friend of a friend. What are the characteristics in your mind, with your experience, to find a good accountant or a good tax planner?
And that could be one and the same person too, I think.
Right.
And again, it might be something where somebody's very comfortable with their family, tax return preparer, but they're not getting tax planning, and they could keep the return preparer and go into a tax planner as well and have two different people. But I think what I would be looking for there is to look for somebody to prepare the taxes or to plan that is doing something similar to what I'm doing, or at least have a lot of clients that are doing the same thing. And so the example that I've used in the past is that when somebody came to me and they wanted me to look in tax planning, and they were real estate investors, that was sort of my sweet spot. It was something that I was doing personally. Well over half of my clients were real estate investors, and in addition to business owners or what have you. And it's something that I felt really comfortable about, either advising them on a planning perspective or throwing the numbers down on the tax returns to get them accepted by the government. So, and something like that. But if you had called me about something that let's say some international offshore tax planning, something that I know nothing about, I knew nothing about it, it would be a horrible fit. So even though I could be a very good tax professional, I wouldn't be a good tax professional for somebody that was looking for that sort of advice. So make sure that the person or the persons that you're working with do what you're doing and also are familiar with it, so that you're not having to teach them. They're hopefully teaching you along, with the records you're bringing and the questions you may have. So familiarity, a good gut feel, good feeling that it's going to be a good relationship with expertise and experience that matches yours. That's where I'd be headed.
I love that, because I think a lot of people make their decisions on, is this preparation or planning individual aggressive or not aggressive, versus having someone that has background, experience, more aligned with what you're doing for a living. Do you feel like there are certain, or maybe there aren't, are there any areas of deductions or credits that typically, maybe these tax preparation or planning groups would tend to avoid, that we should not avoid? Or is there anything in particular that you feel, or is it just situational based for everyone?
Well, it's certainly situational based because everybody is going to be just a little bit different. But again, I think if you're getting into the place where your preparer, your professional are basically on board with you, you should be in good shape. But a lot of planning questions come in. So, for instance, maybe the new law pretty much doubled the amount that you can claim as a standard deduction, and so this year it's up to, I believe it's 24,800 for married couples, and when you're over age 65, you can the number goes up as well. And so what that does is it doesn't allow you to deduct your charitable contributions if you take the standard deduction. But there are ways to make the charitable contributions directly from an IRA so that it never hits your tax return and you get the best of both worlds. And so just a really small strategy or something like that, or not understanding that the laptop computer, is your new Apple, what is the iPhone 12, I think is coming out this fall, but to make that tax deductible in full rather than having depreciated or not even claiming it at all because maybe occasionally you use it for personal reasons. A lot of different things can come into play on the itemized deductions. And is there a way that we can treat an itemized deduction, which is a personal deduction? Is there any way we can move any of that over to a business deduction, which is going to give us a lot more benefit? So maybe a home office deduction, or maybe utility bills, or maybe there's some travel or automobile deductions, or something where you are already incurring the expense or most of the expense and not getting a tax deduction for it. So again, a lot of different things when you get into investments in businesses, and I think that's really where, again, that's where the tax law was written to favor, and that's where if you're not in those arenas right now, you really can't win because you're not playing the right game.
So you're saying, and I want to kind of just reiterate this for the people listening and maybe even new people. Really, to win at the game of tax reduction and tax planning, your best move is to be in a business category. In other words, be a business, because that's the best way to maximize what you're doing. Is that really clearly what you're saying? And when you say business, can you define that? I mean, are we talking like sole proprietor versus entities? And can you just define what business means? Because it clearly sounds like being in some type or form of business is the best way to maximize all of your deductions. What do you mean by that?
Yeah, I think that's a real good point. Simply because when we're dealing with a business, we're just dealing with some sort of an activity that we're doing with an intention to make money. So it's not a hobby. It's something that we're specifically going into with a profit motive. And that can be anything. It can anything that you're doing that you're trying to make money in, and you have a reasonable, honest belief that you're going to make a profit. Sole proprietor, corporation, LLC, all of those fall into we're trying to make money. With the tax rates where they are, it's not beneficial to be losing money. But all the tax deductions and the favorable tax rates are all on the business side. Just to give you just a real quick example, on the personal side, before the new tax law came into place, we had a top tax rate of about 39%. I want to say it's 39.6. That dropped to 37%. So you're talking about just a couple points down. Whereas on the corporate tax side, the top tax rate went from an effective 35% down to 21%. And so a huge difference there. And on all the flow-through business entities, the SCorps and the LLCs or whatever, a new 20% tax deduction just appeared that never existed before. And so in 2017, if I made a $100,000 profit, I'd be taxed on that $100,000 profit. If I did that this year or in 19, I'd be taxed on 80,000 of it because I'd get a 20% deduction. And so these are just savings that simply because I had a business, and again, an activity that I'm trying to make a profit in, I'm now able to capture all these deductions that I wouldn't be able to capture if I didn't have this business.
What about individuals that have operated areas, and I realize most businesses are hobbies for people because they don't make any money and things like that, but I'm saying, like, what about individuals that are looking at saying, look, I spent a lot of money last year trying to do this and trying to do that, but I didn't have a corporation, or I didn't have an LLC or an SCorp. Can I, number one, can I still gain some benefit from that? And number two, what type of things? I mean, cell phone, home office, dry cleaning, like what type of things would work? And did you need a formal entity in order to be able to really, truly benefit from that?
I think the first place you have to start is, when are you actually in business? And the IRS and the tax code and the courts pretty well define that as when you're able to take in your first customer to do your first deal. And so if I start my law practice in January of whatever, 2020, let's say, and I'm now officially able to take clients, if I don't get anybody in January of 2020 because nobody actually calls me, I'm still able to deduct expenses because I'm actually in business. I'm now trying to start to make a profit. And once I hit that point in time, then it's any expense that fits into this category of ordinary, necessary, and reasonable. Those three categories have to apply to any expense. And so maybe my advertising, my office rent, my home office, my automobile, if I have travel expenses, perhaps some meals, cell phone, utilities, insurance. I think you can see, like, the list could go on and on and on, depending on what kind of business you have. Maybe I have a lot of inventory if I have a grocery store. So again, depending on the type of business that I have, would certainly depend on the type of expenses. But pretty much whatever your business is spending money on in an attempt to make more money is pretty much going to be deductible.
What about individuals? And I love the fact that at our summits you can get a lot more individualized, and we even give some of the most commonly missed deductions and a lot of information at the summits. But for the purposes of this call, what about an individual that had a business last year as far as an entity, but they had some expenses that you see that maybe they commonly miss, that they're not flowing? Do they literally have to have all of that flow through the business itself, or is that where they can really look at some opportunities? I'm trying to find maybe any opportunities they have to make some additional deductions or credits or things for last year as well. But if it wasn't necessarily expense right out of the business account, what about those kind of things?
I think that's a good point, in that you do have to look at what kind of structure you have and what kind of record keeping you have and what kind of deductions you're able to take here, with all things being considered. If everything is going through a corporation and you're paying expenses personally, then the corporation is probably going to have to reimburse you for those expenses, and the deduction is going to come at the time typically when the corporation will pay it, not when you paid it. If you didn't have a corporation in place, then you have sole proprietorship in place, and at that point you can claim them. But I think the bigger question here is you have to look at what expenses were incurred. If they were before the business even started, they're potentially still deductible as startup expenses. So a lot of people miss that. They think, well, I started my business on February 1st of 2020, so any expenses in January or in December or in the 6 months before, I can't take. And that's not the case. You can claim those deductions. And once the business starts, then you've got to figure out what kind of structure you want to have so that you don't miss any of these tax deductions that are going to come along. And again, how you have the business structured is going to make a huge difference. And I think that's, I would say that's one of the top 3 or 4 questions I get at the summits is, how do I want to structure my business so that I can take advantage of some of these tax laws or some of these tax provisions that you were just talking about? And to even take it one step further, I think that when we get on the I remember being on a couple of last cruises that we've done, and we sit down and we talk at dinner, and that's where you see like the mindset, as I kind of like go back to the mindset mentality is, my goodness, I mean, we're sitting there having dinner and the light bulbs are going off and they're thinking outside of the box, realizing that if they don't do it for themselves, nobody else is going to do it. And so, yes, if there were some things that were pretty obvious, to get back to one of your questions about, things that may get missed or whatever, if you were let's say a real estate agent, and you came in to me with a lot of income or a decent amount of income, and you had $100 of automobile expenses, I would say, wait a second, George, you got to take a look at this. You guys live in your car, I mean, if you're not out showing, houses in your car, you're not making money. So I know that you're missing something here. But if I'm not really trained to be looking at this particular type of return, I may miss that. So again, make sure you get somebody that is going to prepare your returns that not only you're comfortable with on a personal basis, but that they also seem to be pretty confident in things that you really need them to be confident in.
Yeah, I think it always goes back to that, like you're saying. I mean, that setup and that preparation of who's working with you is the key, in addition to your mindset. Another big question we've had is people are asking, should my business be taxed as a C Corp or an S Corp? What would your comments be to respond to that?
Yeah, well, like every other tax question, it depends, right? Depends on the type of business, the amount of income, specifically the amount of income that's going to be on the personal tax return. So really what we're looking at here is we're looking at two different things. One is, do we have the income tax on the business itself? So that's a C corporation. So your Microsoft and Apple and all the big companies like that, those are all C Corps. And they get the benefit of having a 21% flat rate. We also can have an S Corp, which does not get that 21% rate, but which is taxed at the shareholder level. And they get what's called this qualified business income tax deduction of 20%. So really what we're doing here is we're weighing out the differences between this 20% qualified business income deduction on the S Corp and the 21% flat rate on the C Corp, and seeing which one is more beneficial. And sometimes we'll find that it's pretty clear that one is more beneficial than the other. Sometimes we find that they're both beneficial, and why not have one of each and get the best of both worlds? So again, it depends on your situation, but real strong benefits to both, depending on how much income we're really reporting on the personal return.
Well, and it sounds like when you start listing out things like cell phone and home office and car and utilities and internet and things like this, even for someone at a small level, it sounds like there's not a specific benchmark level that they should be thinking that's when I should be in a business. It's really, if you want the benefits, you're going to start at any level and create a business structure to be able to benefit from that. Is that correct?
Yeah, I think that's the way I would get going. I mean, if it's something where you've always wanted to be in business, or perhaps you're in a situation where you've been an employee and now you're transitioning into a consulting role, or going into semi-retirement, or just whatever it happens to be on that, that's where all the tax deductions lie. And so to me, I would just get started with a sole proprietorship, just to get started. Now, I wouldn't recommend anybody to do business that way because you don't have any asset protection. But I've seen a lot of business get started with just a simple one-person LLC. And at some point in the future, that LLC then, where you are getting some liability protection, unlike the sole proprietorship, but the LLC then can be taxed as an S Corp, or it can be taxed as a C Corp. So we have flexibility down the road where you just get started today. You don't really know what your business is going to be doing a month or 6 months or a year or 10 years from now. And it gives us flexibility to allow it to change as our business grows over time.
Yeah, I think maybe the reason a lot of people have told us that they haven't had the mindset and they haven't felt comfortable, and business is a great strategy, but I think that the fear of audit or the fear of or risk of being audited is something that really drives people as well. So let's assume someone's getting really proactive with tax preparation and tax planning, and they've got a business. The question I'm sure getting a ton is, how aggressive can I be before I get audited? So I wanted to really ask you, maybe you could talk a little bit about what's the risk of getting audited? What's the real risk of getting audited, and how aggressive can I be before I have to worry about that? I know it's a very deep subject, but maybe you could start to give us some thoughts on that.
Yeah, absolutely. The first thing I think is to realize that there's no guarantees with audits, that the IRS does random audits, and if they happen to pick your return, they pick your return. So, there's nobody, when I see a tax professional say, well, I guarantee you if you use me, you won't get audited, that's not true. The flip side of that, though, is that why be afraid of the IRS? The IRS last year, we were looking at about a 0.6% audit rate. So about 6 people out of 1,000 got audited overall. And SCorps and LLCs that are taxed as partnerships, the number was lower than that. It was like 2 or 3 out of 1,000. And of course, depending on what income you're making, once you get over $1 million of income, or if you don't show any income, you end up with a little bit higher odds, but it's still very, very low odds. And I think what I would be looking at as far as aggressiveness goes is that I would be aggressive in every form of my tax planning and preparation. But let me define what I mean by aggressive, because I think that when some people hear aggressive, they'll think that, well, I'll just claim anything that I want, and if I'm not one of the half a dozen people that gets audited, well, then I'm home free. And that's absolutely not what I'm saying. What I'd be suggesting here is that we're going to take every tax deduction that the law permits. And of course, in order to do that, we have to know what tax deductions are available, and that's where the planning comes in. And then we're going to maximize those tax deductions. So for instance, I can look at it and say that I'm going to buy a heavy SUV this year, one that weighs more than 6,000 pounds, and I really like this particular model that is going to cost 60 grand. But I want to upgrade it. I want to get another 10 grand on it. I can do that and get the full tax deduction. So the reality is I can be as aggressive as I want, as long as I'm doing it within the parameters of the law, and that I'm not sort of stepping over this sort of very difficult to define line of this is okay, and then crossing over the line to say this is not okay. And there's a lot of different things that we know is just fine. We know that if we deduct our personal groceries, or let's say clothing for our kids, we've stepped over the line, and that's not okay. We also know that if we put an ad in the newspaper or online for our business, that advertising expense is okay. But it's where you get into the gray area where we're not really sure if it's okay or not okay. That's where we get into, we can be aggressive there. If we're not sure if it can go one way or the other, why do we need to assume that it's going to go against us? And I think that's the gray area where a lot of the tax issues, to me, are played, and the game is really won or lost right there.
Yeah, that there again goes back to mindset, right? Is it a fear-based mindset with doing your taxes, or is it a logical, confident mindset? Because I think Kendall threw up a minute ago just some of the statistics of the audit risk in the past, but I tell you, I didn't realize how, and I'm not like you said, we're not proposing to not worry about this because it's random, but it's a very, very small number chance that you're going to get audited, and especially if you're in a lower income level. So that kind of leads you towards the idea that maybe you could be a little bit more aggressive if you don't have the confidence and belief. but I was really surprised to see what low numbers for your risk of being audited or your odds of being audited. And I don't think people, I guess like anything else, people think, man, I'm going to be the one guy that gets audited, but I think they don't educate themselves to know what the numbers are, because just like investing in business, a lot of times if you go by the numbers rather than by your gut, you're going to make better, more sound, maybe even more aggressive decisions, right?
Well, yeah, when you have all the information that's available, and I think this is one of them that's available, and the IRS can simply randomly audit your return, or even more commonly, maybe there's a matching issue where somebody reported a 1099 of $50,000 to you, and you didn't report it on your return, so the computer can flag it. Or maybe they're doing specific projects, or that your preparer is under investigation, and therefore they're auditing everybody that the preparer did returns for. So there's lots of different reasons why a return is going to get audited, but to have the mindset that I don't really care if my return gets audited or not, that is a cost of doing business, either as a citizen of the United States or as somebody that's doing business in the US or in Colorado or wherever you may be. That's just a cost of doing business. And so the mindset to me is that, yes, we can be aggressive. We're going to take every deduction that the law permits. And if the IRS or some state taxing agency wants to audit it, that's fine, because I've got the documents to back up every number on the return, because I'm organized. So again, right back to the very beginning of, if we're organized on this stuff, we don't have the fear of taking these deductions, because we know that with our organization, the IRS, I mean, they're going to come and look at the records, make sure that the records are in order, which we know they are, and they're going to move on to somebody else.
Yeah, it's definitely, it's like many of our seven-figure mentors say, that they just assume that a risk of audit is something that they have as a act of doing business, right? Are there some specific triggers are there specific triggers, like I'm finding I file extensions, or I deduct these types of things? Are there certain triggers for audit historically that you're aware of, or is it just not something to be worried about?
Well, they do have statistical analysis that the IRS does on returns. And so if there's numbers that are really out of line statistically with national averages, for instance, let's say that I make $100,000 a year and the average person donates $5,000 a year in that income range, and I donated $80,000. So they may want to look at something where it's out of line statistically. They also look at it industry-wise. And so let's say that an average lawyer or law firm would spend 1% of their revenue on advertising. And I'm just making these numbers up, but if that was the case, and now my law firm is spending 40% on advertising, there might be something out of whack. So looking at those types of issues, but in general, there's not really a tax deduction that you can claim that's going to get you audited. So simply because you claim your automobile, or you claim the home office, or you claim retirement plan deductions, that's not going to get you audited. Of course, if you do get audited, the IRS may want to look at those deductions.
So yeah, when you're in that situation, another random question I was just going to ask you, because I know several individuals that fall into this category, but they actually feel, and I'm not asking you whether this is good or bad, but maybe you can comment on the strategy thought. A lot of business owners and investors have said to me that they would much rather lean on the edge of getting audited, just because the cost of the penalties and fees are outweighed by their ability to create a return with keeping money in their pocket. Is there any upside downside to that? Is there any comment you would have on that, just even strictly from a financial standpoint?
Well, from a financial standpoint, certainly the less you pay in tax, the more you'd have to invest, and presumably the greater return you'd have on your investment. But from a tax perspective, I think that the hard part here is where is that line? And if you're continually crossing that line, then we can get into a situation where the IRS may say, this isn't just aggressive, this is fraudulent. And huge difference between the two, where you start getting into tax fraud issues, that's where the conversation needs to stop, because there's so many loopholes, so many advantages to being in business and doing it legally that we don't want to go there. Now, again, the problem though is figuring out where is that line, and there'll be some tax preparers, professionals, what have you, that the line could always be moving, and some are going to be more aggressive than others. And I think that's where the gut comes in here, where go with your gut feel, talk to the tax professional and see what she's saying, see what he's saying. How in line with what you're trying to accomplish are they? You know, are they too aggressive, where this just sounds too good to be true, or are they not willing to take any tax deductions because they're afraid of getting audited? And I think you have to find the happy medium for yourself, which could be very different than the person that you happen to be, you know, sitting next to on the train tomorrow or whatever. So I think that's kind of what you have to look at, is you still have to go with your gut.
Well, I appreciate you saying that. It's always good to just, that's one of the things that I've found with the most successful investors and business owners, is it's not about getting the answer as much as it is asking the right questions. And that's why we're trying to kind of spur that a little bit more, get people thinking, get their mindset right. I know that a part 2 to this webinar we're going to be doing is going to get very detailed into real estate investors, stock investors, small business owners, and things like that for this upcoming year. But really, there's a reason that you constantly hit, and we want to constantly emphasize the idea that it's not so much about the answer as it is the mindset. You're asking the right questions and understanding why certain things are the case. And so that's why, you know, typically, you know, we would jump on and just say, give us the top 10 deductions, give us 5 of these, 4 of these. But we really, I think you would agree, you've seen over time that the more you can affect the mindset of how people see and plan and challenge their taxes, the more success they're going to have. So, but let me ask you a couple of more specific questions. What about things like medical reimbursements? We've had people ask us about, you know, what you can do with medical reimbursements. We've had individuals ask us, you know, whether this is, you know, business-based or not. Do you have any thoughts on medical reimbursements, allowances, and things like that?
Yeah. When you get into the medical expenses, the main problem that we have is, in order to deduct them on the personal return, they have to go over 7.5% of your income. And so that's a huge hurdle for a lot of people. And the second part of the problem is that not a lot of people are itemizing deductions anymore, with the standard deduction considerably higher. So a lot of the medical expenses just sort of go away. They're out the window. And that's where a business comes in, where we can now deduct the cost of our health insurance, no matter what business we have. With a C corporation, we can do a medical reimbursement plan where we can deduct copays, or, you know, other out-of-pocket expenses or expenses that aren't covered by insurance, and we can deduct those directly, rather than having to go through our personal return and pretty certainly not going to get any tax deduction for the medical expenses we have. But again, you've got to be structured properly to be able to take advantage of this.
Got it. No, that's awesome. One of the real benefits of the summit, and the reason we do the summit, is because there's a situation and a scenario where you're able to kind of get a little bit more specific. And I think we're going to cover a little bit. What at this upcoming summit in Phoenix, and then what I'm going to do, just to kind of prep some of the listeners, because of the sake of time, we're going to take a few questions. And so if you have some specific questions, you can jump in our chat box or our question box and put your questions in there. We have a couple that we're gonna throw at Scott here in a minute, but feel free to ask some questions in there. But Scott, what are some things, you're going to be joining us in Phoenix, and we're super excited. If you're on the call and you want to get a bunch of detailed information about our event, you can go to protectwealth.com/free ticket. We have you know, tickets to our upcoming summit that are normally, you know, a $997 value that we're offering you. You're welcome to get. We've got Q&A and agendas and details specifically as to what we're going to cover. But Scott, what are some things that you're going to be covering at the upcoming summit that obviously we didn't cover here? And I know there's a lot of things, but is there anything high level, what would be the topics you're going to be talking about live with us in Phoenix?
Well, yeah, there's a lot of things we didn't talk about here tonight, but I think with Phoenix and with any of the summits, really, we're looking at a real estate, we're looking at stock market, we're looking at business, we're looking at asset protection, estate planning, all these different moving parts. And all these different moving parts all have different tax issues. And what I'm going to try to do in Phoenix is try to incorporate a lot of the tax strategies that we can utilize if we're using different business entities, or if we're investing in rental properties, or we're doing different things that are going to now allow us to be able to take advantage of the new tax laws.
Yeah, I really like that the summit is generally geared towards the specifics of what we'll be doing at some of our follow-up webinars of real estate, stock, business, professionals, and things like that. But I'll tell you, there's just a huge emphasis we like to put on mindset. So we really appreciate you doing that, because I think sometimes people don't realize that if you have the right mindset, you're going to get to the answer one way or the other. So let's jump to a couple of questions. I'm going to throw a couple at you, Scott, just we have coming in from our questions section, and then we'll transition off and appreciate you for your time. This we have Bill who said, IRS says they're going after conservation easement. What are your thoughts? Still a valid strategy?
Well, yeah, conservation easements have always been a valid strategy from the sense of it's a way to get a tax deduction for land that that you're owning. The problem with easements and donations and anything else is that some people get way more aggressive than they should, and they start taking higher valuations for what they're giving. And so the conservation easement, not any different than valuing a work of art or clothes that we're giving to Goodwill or whatever else we're trying to value for tax purposes. We can value those on a fair market basis, but when we start getting a little bit out of hand, IRS is going to come down, and they definitely have come down on that particular issue.
That's great. That's great. Okay, another question we had from Stephen was suggestions for what to do with RMD distribution that is not needed for living expenses, where it doesn't add to taxable income. Can the money be put into a Roth IRA?
Well, you could do it, but I'm not sure why you would want to do that, because it would be a taxable event. One thing I guess a couple things on the RMD. So this is a required minimum distribution. This is from a regular traditional IRA, so it's not a Roth IRA. And these RMDs, you were required to take them by age 70 and a half. Why that half is in there, I don't know, but 70 and a half before this year. As of 2020, that age is now 72. And one strategy to take if you don't need the money is that you can make a donation directly from the IRA to the charity. And so you never take possession of that money. So if I'm going to receive $100,000 from my IRA, if I take the money, I'm taxed on the $100,000, and then I may or may not get a deduction for the donation to the charity. But what about if I took that $100,000 from the IRA and took some of it and transferred it directly to the charity? Let's say I did half of it. I would then be taxed on $50,000, and the other $50,000 would go directly to the charity, tax-free to me, in fact. And so, again, it depends on how you're looking at it, but Roth conversion, so for this gentleman to be converting to a Roth while he's already taking out RMDs, probably not going to be recommended, but I would talk to a financial planner on that, because it's a probably, not a definitely.
That's good. That's great. It seems like we have a lot of questions around the healthcare type of things. So we had a couple that I thought you might comment on, and you've really kind of answered this, but let's kind of hit it home. So is a C-Corp the best vehicle for healthcare reimbursements? And obviously a lot of your answers are depends, but do you want to just comment again and just close the loop on that?
Well, with a C corporation, they're called 105B plans, section 105B of the Internal Revenue Code. And basically what that says is that the corporation can reimburse its employees for medical expenses that they incur. That can include health insurance, out-of-pocket, co-pays, what have you. The problem with this whole sort of medical reimbursement plan is that it doesn't work when you go through an S corporation or a flow-through entity. And the reason for that is that the amount of the reimbursement, while it's deductible by the company, is going to have to be included in income of the employee who receives it. And where you're in a C corporation, that's not going to be the case. So if that's, if the medical reimbursement plan is a fringe benefit that you really, really want for whatever reason, then you need to have a C Corp to be able to do that. Also remember that all the business entities have the potential to be able to deduct health insurance. So forget health insurance from this equation, because that can be deducted from a sole proprietor, can be deducted from SCorps, LLCs, partnerships, what have you, just with a few requirements on income. But in general, that's the case.
Awesome, awesome. And is there a way to deduct long-term care insurance?
Yeah, same thing there, where you're going through a company, much easier. Going through yourself as an individual, now it becomes, another one of the itemized deductions that's probably going to go away.
Yeah, it's interesting to also forecast your planning. I noticed you talked a lot about that at the last summit when you're making major purchases, when you're looking at long-term deductions. Looking ahead is as important as looking behind and looking in your current way of doing business, because making a decision could completely change when you factor in the tax consequences or benefits of it.
Absolutely. You may have a decision that you could go with decision A or decision B, and both of them are, from a business perspective, pretty equal, but A could have much better tax benefits than B, and therefore make it a much better business decision just based on the taxes. Although I would advise typically that don't make business decisions based on the taxes, don't make investment decisions based on the taxes, but certainly consider the taxes as a part of the overall due diligence that you're going to do with any investment or with any major business purpose or major life change, marriage, divorce, death, different transitions in life that we may be going through, where our mindset may need to change a bit to adapt to the changes that we're going through.
Yeah, that's huge. That's a great response to that. Thanks, Scott. Here's a couple questions that are kind of specific, but I think it could be applying to several people. I've been told I cannot write off clothing for my business, but I can write off having the logo put on the clothing. I have a home inspection business. Is this true? So this might go, Scott, to the idea of writing off clothing / dry cleaning and a couple of other things. How do you pull those into business deductions?
And this is a good point, I think, as well, because it's another part of looking outside the box here. If you ask an IRS agent, can I deduct the cost of my clothing? The answer is no. And that would probably be correct. But if you take it a next step further and you say, can I deduct the cost of my clothing for business? Now the answer goes from no to maybe. And so now we're getting somewhere, right? We're now getting us from a position of we can't deduct it to maybe. And so then the question becomes, well, what's the maybe part? How can I get it to be yes? And you get into work clothing there, where you have specific clothing that really can't be worn outside of your job. So for instance, I cannot deduct the cost of a business suit, even though I need that for my job if I go to court, because it can be worn outside of work. But now I'm an airline pilot for United Airlines. I'm a doctor, or I'm a nurse, or I'm a specific occupation where I have to have a uniform. Now that becomes deductible. And the same thing when you get into the logo clothing, where you have a business, and I don't recall what the business was, but let's say it's a plumbing business, and you put your logo on the shirt of the plumbers that you send out. Now that shirt becomes deductible. It's an advertising expense, logo, marketing, what you want to call it. Without that logo on it, though, it would not be deductible because you could wear it outside of work, presumably.
Yeah, I definitely think moving the question from a yes, no into a maybe status gets you really creative, right? You can start thinking, is it logo wear? Is it stuff I can't wear somewhere else? Or is there something I can use that would not be something I'd wear somewhere else and still do the job and be able to deduct? You had made a comment on dry cleaning, and I just want to kind of kick back on that a second and ask you again. Dry cleaning is not necessarily deductible unless you're in travel status, yes or no?
Yes, that's correct. Dry cleaning is not deductible unless you're in travel status.
Which means I got to be out of town, which means what? What are some creative ways to create that?
Travel status, what we're looking at there is away from home overnight for business. So I have to be spending the night somewhere away from my tax home. So for instance, my tax home is in Denver. And if I attend a conference, or let's say I'm attending the Phoenix Summit, I'm obviously away from home overnight. I'm spending a couple nights in Phoenix for business. And so I would qualify. So my business expenses then become deductible, including laundry, including my cost of my meals, my cost of my airfare, Ubers, all kinds of different things become tax deductible once I get into travel status.
All right, we're gonna just maybe go with 2 more questions and then we'll kind of wrap it up. Appreciate your time, Scott. These are kind of very specific questions. This one I think we would normally answer, but I want to have you answer this one. It says, I have 3 properties rolling under a holding company, management company. Do I need a separate bank account for each LLC since the holding company handles all the transactions? I'm just going to let you, kind of kick to that because I think that, they're thinking through the tax preparation deal, but obviously it's a business and it's managing those LLCs. Do I need separate bank accounts?
Well, you've got different questions involved here from an asset perspective, asset protection perspective, or a tax planning perspective, or what have you. First of all, whether you have one bank account here for the holding company, it could depend on how you have it set up. So is it a series LLC type of situation? Is it a holding company and then we have LLCs underneath it, in which case I would have each LLC have its own bank account. But I think from a tax perspective and planning and preparation, whether you have one bank account or many, you need to make sure that each one of the rental properties has its own separate books and records. You need to have that from a business perspective. And we also want to have that from a tax perspective when we're trying to make decisions on how to allocate, or should we allocate all the expenses and call it a real estate enterprise, or should we not, or what's going to be our best tax strategy? So different questions there as far as how to operate the business. But I think a lot of asset protection attorneys would just say, yeah, let's have multiple bank accounts here.
And separation.
Yeah, exactly.
Yeah.
For separation purposes.
Well, there's no doubt that one of the key things we like to talk to individuals about at the summit is that you need to start looking from these different perspectives. You need to start looking from an asset protection perspective. You need to start looking at things from a tax reduction perspective. And then ultimately estate planning or running your business is key. So that's a great question. There's no, bad questions. There just really is. It's more about asking in the frame of mind and your mindset around them. So that's good. There's another just random question I'm going to kind of put here. Let's see if I can answer this one here for, 2. One from Sylvia. She says, I heard the IRS is requiring a living trust. Is this correct for homeowners? I heard the IRS requires homeowners to have a living trust. I'm not sure if that's the question. I haven't heard that. Obviously, Sylvia, I don't believe that's the case, but it depends on if they're referring to some other topic.
They must be, because a living trust is a probate avoidance estate planning vehicle, and estate planning issues are on the state level. So IRS really has nothing to do with telling you what you should or shouldn't have, other than they're going to tax it if you have quote unquote too much. Right.
Interesting random question here as well. A person in the ministerial staff at a church who does not receive a 1099 income from the church, but is assigned to the staff at that church, in your opinion, what would be the best method or opinion of creating some deductions, CCorp, LLC, etc.? I think they're just looking at a creative way to take this and create some deductions for themselves. What are your thoughts there?
Well, I think that they'd have to, first of all, there's special rules that are in place for ministers, pastors, what have you, housing allowances, different things that are very beneficial. And I think you have to look at the whole part of it. Plus, you're also dealing with typically a nonprofit, not a for-profit enterprise, with a lot of different religious establishments. So in those cases, we don't typically need to have or don't worry about tax deductions because of the not-for-profit status, the 501c3 type businesses or organizations, I should say, not businesses. So in something like this, I mean, you'd have to look at, well, what sort of activities are being done outside of the ministry, and then to see how those should be structured. So in other words, do we have a minister who is already getting some tax deductions as a benefit of being a minister, but also may have rental properties and may need an LLC on the outside to protect those? And I think that's where, again, it goes right back to the mindset, and it goes back to the planning that, everybody that is listening to this presentation, we're all different. We all have different life situations, different businesses, different goals, different family situations, and all of that stuff has to come into play. And I think that's one of the things that I benefit even from at the summits. I've been doing these for so many years, is just getting to hear a lot of different stories and figuring out how a lot of different people have overcome different obstacles, whatever they happen to be. And so being able to get the estate planning and the asset protection and all these different things coming together, and then I look at it from, okay, all these different parts, now let's throw the final part, and that is, how can we bring the tax bill down?
Yeah, I love how you just summarized that, because when we sat down and thought about what core questions we wanted to do in this webinar tonight, Scott, you know as well as I do, we had a million questions around, I have this many properties, I have this type of business, I have a stock account, I have cryptocurrency. Like, we could have gone on for hours and hours of specifics, but what I've learned from you over the years at the summit and at some of these events, which are an amazing opportunity, if you haven't registered already to join us in Phoenix, you'll get a little bit more time with Scott, is that you almost always bring them back to, I'm not just going to give you the answer, I'm going to get you thinking differently about how you do this. And so if you're on this call tonight, we have quite a few people on, and you haven't gotten that message loud and clear yet, we are going to hammer home over and over that your mindset is key to being able to optimize and maximize your deductions, and what you think, and not just the answers, but the questions you ask. And then, like you say, Scott, why are you asking these questions? Really get thinking about what you're trying to do, because sometimes backing up and coming from a completely different angle gives you some of the answers you want, but more importantly, you might just get answers to the wrong questions. So we really appreciate your time, and I really wanted to draw that out for people, because we found that with the 7, 8, 9-figure mentors that we work with, and Scott is by far the leading expert, in my opinion, that we're connected with for this topic, it's always about mindset. It's always about the way you think, and it's always about then your commitment level to maximizing what you're doing. And I know we're going to be having another follow-up where we get into a lot of specifics for investors, but I think you've really hammered that point home. And so, Scott, is there any other last-minute thoughts you would have for individuals on the call back to 2000, for 2019 or moving forward, that you wanted to just kind of cap off before we end here?
Well, I think the mindset is the key part of this, and keep asking questions. To me, the answers aren't as important as the questions. And what I mean by that is, I get asked sometimes, well, what section of the Internal Revenue Code allows me to do X, Y, Z? And most of the time I'm clueless. I have no idea what the section is. But the good thing is that that person knew that there was some sort of a section that may allow somebody to do something, right? And so that's the question part. And to me, that is the important part. We can always get the answer, but if you're not asking the right questions, you're not going to get the right answers. And sometimes when we start into the tax planning process, and you'll ask a question and you'll get an answer, the answer then will trigger 5 more questions, and that's where things really, really open up. And so don't be afraid to be aggressive. Don't be afraid to ask questions and just see. I mean, it's very possible that what you're thinking can't be done, or it's not legal to do it, but it doesn't hurt to ask. And ask away, because otherwise you're going to end up overpaying if you don't do it.
Yeah, well, I'll tell you, and I want to highly recommend to anyone that's still on the call that you go to the protectwealth.com/free ticket site and register for the upcoming summit, because one of the things we're able to do at that summit that we just can't do on a call is when we integrate some of the best mentors in the country and in the world, like Clint Coons, who's one of the premier asset protection and business structuring experts, side by side with Aaron Adams, who is a 7, 8, 9-figure real estate investor that real estate invests. He doesn't sell education, he does the investing. And a Mike Koval, who does stock, Forex, currency. And these individuals are there while we're alongside with Scott, and we can talk about asset protection, tax strategies, and estate planning or business strategies in these case study scenarios. It really will give you the opportunity to get in deep with what you're going to do. And there's no better opportunity than coming up here in Phoenix. And by the way, as another note, we do have a room block for the hotel. And so you'll want to jump on that, because that'll go away. It'll go quickly. Definitely these events are going to max out. We already have unbelievable number registered. It's going to be one of our biggest events of the year, even though we keep it to a specific size so that we can interact. But this is where we'll be able to really get Scott in his element with right alongside real estate investors, stock investors, professionals, doctors, individuals that have a lot of specific questions, because we really see the benefit, like Scott said, of answering and asking questions around multiple perspectives from an asset protection standpoint, a tax standpoint, and what's best for your business standpoint. Because taking deductions off your business isn't the question if you have a business. It's also what's the best for my business and what's the best for my asset. So I highly recommend you attend, see us in Phoenix. Scott, you'll be down in Phoenix. We've got some really, really good content that's going to be dropped there. And once again, just to kind of close out the call, Scott, thank you so much for your time and for your wisdom. You have helped, I mean, I can't even tell you how many thousands and thousands of our students and case studies and testimonials, which you'll see on the website. Thank you for your wisdom, your brilliance, and I appreciate you spending your time here with us this evening.
Thank you very much. My pleasure as always, and look forward to seeing everybody in Phoenix.
Great. We'll go ahead and put the link in the chat box and in the answer, so you can click on that. Thanks again, Scott. Have an amazing night, and we'll talk with everyone soon. Thanks for joining us tonight. Have a great night.